Olix Network 18, Mission Poshan, Bhavishya Roshan.
Are we going to get the first rate hike in 4.5 years? The Reserve Bank of India's Monetary Policy Committee deliberates on this issue Monday through Wednesday and announces their decision on Wednesday. But CNBC TV18 Citizens Monetary Policy Committee is here with me right now to deliberate what they think are the underlying inflationary forces and growth impulses, and hence what the vote ought to be. Joining me now are Chairman of the Citizens Monetary Policy Committee, Dr. Pranab Sen, former advisor to the Planning Commission and former Chief Statistician, Sajid Chinoy, the Chief Economist from JP Morgan, Sonal Verma, the Chief Economist from Nomura, Shaumya Kanti Ghosh, Chief Economic Advisor, State Bank of India, and Shavaran Chakraborty, the Economist from Citi. Gentlemen and lady, thank you very much for joining me. First up, Dr. Sen, what are the growth and inflation impulses that you would monitor before you take a rate decision?
Well, I think with yesterday's GDP numbers out, I think we've got a little more clarity as to what's going on. So let's start with the inflation part of the thing. The inflation story is starting to look really dangerous now. Core inflation continues to work upwards. We are coming into the Kharif season, which is principally a rice growing season. And if the 50% plus MSP is announced, that's going to add another maybe, the rice MSP will go up by about 17 to 18%. So that's going to add another impetus. The rupee is weakening, the oil stays up. So all of those add up to, I think, strong inflation challenges. Yesterday's figure on the GDP was interesting because it came in, I think, stronger than expectations. But much of it is driven by government expenditures. So now if one looks forward on the growth front, next year the downside is that government cannot maintain this pace of growth of its expenditure. It's going to come down sharply. This would have been okay if it had been only on the consumption expenditure side. But the problem is that a lot of the investment numbers we are seeing is also driven by public expenditure. And we still don't have an indication whether private investments have really started to respond. My sense is that it hasn't. So we are looking at a mixed picture for next year. Of course, the other positive is that the global economy is growing. There is coordinated recovery across the world, and hopefully we should be able to tap into it, particularly with a weaker rupee and some of the GST problems having gotten sorted out. So we've got a mixed bag. But, at the moment, I think the real trade-off is almost certain inflation and a somewhat questionable growth.
Okay, somewhat questionable growth. The other big, of course, element which the Reserve Bank will have to take into consideration would be what's happening on the currency front across emerging market currencies. Sonal, from your perch in Singapore, would that be a compelling reason to give a boost to the rupee, or at least keep it stable, the reasons for a rate hike?
Yeah, Latha, I think from a purely inflation perspective, average headline inflation, excluding the HRA impact in FY19, may still be around 4.5%. So at 6% repo rate, there's still a 1.5 percentage point real rate cushion. But clearly, the global environment has completely changed in the last couple of months, given the increase we've seen in oil prices, along with the stronger dollar, US interest rates moving up, and across emerging markets, we've seen pressures come back on the balance of payment front. So, I think from an inflation targeting perspective itself, the changing global environment clearly means an upside risk to the inflation outlook. But purely from a macro stability perspective, this has become quite important. So we have, of course, seen countries like Turkey, Argentina, even Indonesia, which has delivered a preemptive rate hike, and India, with its twin deficit, also needs to ensure that macro stability remains a priority. So I would say yes, from an external and changing global dynamics perspective. But if you superimpose even the domestic changing growth inflation dynamics, both the things actually point to the same direction, which is that there is a need for the monetary policy cycle to now turn.
Okay. Well, Soumya, would you want to add to that? Is the global scenario indicating that there is a need for India to step up with a rate hike?
See, before I get into the global part, just very quickly a point which the chairman said in terms of the data released yesterday. I think the GDP numbers data released yesterday has some very positive surprises, but beneath the numbers there are two things which needs immediate attention. The first thing is that the nominal GDP growth rate has now declined to below 10%.
Yes.
I think that is possibly the first time in decades. The second thing is that the consumption expenditure continues to be lower, and it is coming on top of a lower base last year. And the other thing is that if you actually look into the per capita PFC, that has actually decelerated, indicating that there is a negative income shock across decile groups. So that's a point of consideration. That's mostly because of the agricultural GVA deflator is significant on the lower side. So that's one thing. So the nominal agriculture is not picking up. So there is some uncertainty on the domestic growth front. If you go into the global growth front, I think even after all the talks about the synchronous growth recovery, I think there is now an element of an asynchronous global growth across the world. For example, Japan has shrunk for the first time after 8 quarters. Then if you look into the data of Italy, which happened in a couple of days back, I think a lot of these banks like Spain, Germany has a lot of exposure to the Italian debt, so that's going to have a negative impact. The other thing is that if you look into the emerging economies purchasing PMI index, that has declined to a 16-month low if you look into the export component. And the Korea and the Chinese export orders are actually at 10-month lows. So these are some numbers which we have to take consideration. And the other thing is that very interesting, just after these Italian crises, if you derive the probability from the Fed future rate, that has significantly declined to below 50% for September. So while we may be sure for a June rate hike, I am not sure about a Fed rate hike in September. And also the wage growth at 2.7% of USA is still lower than what it was in the pre-crisis period. So
global growth is not a given.
Not a given at this point of time. There is a lot of uncertainty on the global growth and also the domestic growth. So if I take all these factors into consideration, I think the central bank needs to take into account these things before taking a call.
Definitely important. Continuing with what Dr. Sen said, Indian growth could have some weak soft spots despite the very good headline number for the 4th quarter, and global growth question marks. I think George Soros also raised that issue very prominently. Shamiran, the uncovered topics, which although everyone has spoken about it obliquely, fiscal problems, loan waivers, election season, and of course MSP. All this would mean probably fiscal looseness and therefore the monetary tightness warranted?
Well, the way I kind of loosely put it is that you are seeing a situation of relatively higher inflation, particularly core inflation. You are seeing a situation where headline growth is high, and even taking into account Chairman's point about the growth being driven more by government, less by private, it all adds up to aggregate demand. So there is an aggregate demand push. There is a somewhat weakening currency, and there is a somewhat loosening risk of a fiscal. So this combination of high growth, high inflation, loose fiscal and weaker currency, in our view, has to be combated to some extent by a tighter monetary policy. Otherwise, you might soon lose the equilibrium path completely. So that's where I guess we will have to start tracking now that how the fiscal risks from MSP, oil excise duty cut, or GST, how these three particularly pans out to figure out that to what extent we will require somewhat of a tighter monetary policy to combat that.
Okay, I'll come back to you whether this merits only a change in stance or whether this actually merits a change in policy action, because, I mean, as the chairman and Soumya are pointing out, there are soft spots in growth, both domestically and globally. But Sajid, we all talk about fiscal looseness and loan waivers. To be fair, the government has kept somewhat to the trajectory, and the fiscal numbers have indicated that FY18 is 3.5%. So, lived by the letter, you will have to say. Can you, presage that there will be fiscal looseness, and is monetary tightness called for just yet?
No, you can't presage that, I think, because I think for the most part the government's been very responsible on the fiscal front. Even the last few weeks, the big pressure to cut excise duties, they've not bucked to that pressure, and they've been very responsible. I think I agree with Dr. Sen here that I think both for the reasons he mentioned and Soumya mentioned, we should not take strong Indian growth and global growth as a given. Given that monetary conditions have tightened in India the last 6 months, oil prices are 30% higher than last year, and you're undergoing a deleveraging process, I think at best we get a limited pickup, number one. Number two, we're seeing some slippage in European growth in the second quarter, and the stronger US dollar that results from that is going to have some feedback loop on US growth, US inflation, and therefore how the Fed acts. So lots of moving pieces. But let me just say this. I think the beauty of a flexible inflation targeting framework is that it imparts some predictability to the process. So far, the RBI has been saying our policy decision will be guided by where inflation is 1 year ahead. Now, purely from a cost push perspective, higher oil prices, a weaker currency, higher food prices that are imminent, and the fact that there's stronger pricing power, as witnessed in the core inflation numbers, we can with reasonable confidence forecast that on an as-is, where-is basis, 1 year ahead inflation will be about 5%. If your medium-term target is 4%, it's an early inflation targeting regime, your forecast is 5%, that should be enough for the RBI to tighten monetary policy, even if there is not so much conviction on domestic growth and global growth, growing gangbusters. And that's the sense, I think, that's the reason we believe that, some tightening is on the anvil in the coming months. Whether it's June or August, I think, is less important.
Shamiran, let me start with you now. You put on the table the fact that, there are soft spots in growth, but core inflation, etc., are picking up. So do you think that it makes sense to warn and therefore change stance? But is it too early, you would say, to hike rates?
That's probably the most debatable discussion, that as an inflation targeting central bank, can you really risk falling behind the curve, at least from the eyes of the market's perspective? So if we just look back from April onwards, we have got two inflation trends on which, depending upon which core inflation measure you like, it has gone up between 50 to 70 basis points. You look at oil prices in INR terms have gone up 16%. Now, not fully probably passed on into retail prices as yet. So if you think of these building up of inflation pressures, then in our view, probably it's better for the central bank to start early rather than wait for the August policy. Yes, the big uncertainty is on MSP, which will probably get clarified only after the MPC meets. But at the same time, if the MSP leads to some sudden spot in prices, then in August it might look to be too little, too late. And who knows, there could be pressure on the central bank to act more if they delay the first rate hike. So in that sense, probably it makes sense to start early, given that the inflationary pressures are now quite acute and quite visible.
Okay. Well, let this be a little more freewheeling. Sonal, I mean, what is the point of this rate hike? Will it make a difference? I mean, the yield curve in India is looking like it's already factored in 2 or even 3 rate hikes. The 10-year is at almost 7.9, 7.85, 7.9, and even the 2-year is at 7.5 to 7.6. Will this rate hike make a big difference to the cost of money practically?
That's a very important point, Latha. I mean, market interest rates, bank lending, deposit rates have all moved up despite, policy rates being status quo. So an implicit tightening of financial conditions have happened. So the effectiveness, though, I think the signaling impact of a policy rate move cannot be discounted. The core inflation numbers in the month of April are clearly extremely alarming. It's sort of consistent with the domestic demand pressures we have seen, which is reflected in the growth numbers. The incremental upside risk to inflation because of oil, INR, and various factors would suggest that, with already the pressures being quite high and upside risks, clearly the deviation from the medium-term target is now clearly visible. And second, like I mentioned, the macro stability considerations given the rise in global risk premia is something that India as a current account deficit country cannot really ignore. So yes, the tightening of financial conditions have happened. That may lead to some moderation in growth, but the adjustment on the policy rate front, and particularly from a signaling perspective, particularly given that we are in the very early stages of inflation targeting, I think the credibility cannot be underestimated. And therefore, given the lags anyway with which monetary policy works, the sooner would actually be better.
Okay. Let me put one more thing on the table. Inflation trajectory. Sajid, will the Reserve Bank have to, and the MPC, and will all of you have to willy-nilly revise your inflation target upward? The last policy brought down the March forecast, brought down the first half forecast for the current year, and the second half forecast by 10 basis points. Will some of these have to get reversed?
I think they will have to get reversed. All of us are in the process of doing that. I think, and to be fair, there are lots of moving pieces. Food prices have actually not picked up as much as we thought in the summer. There is not enough clarity on the MSPs. Everyone thought 6 months ago oil cannot breach 55 or 60. It's now closer to 80. The dollar has strengthened 5% in the last 6 weeks, so lots of moving parts. I would pay less attention to the inflation forecast in the next 6 or 8 months because there are so many base effects in opposite directions that you get a misleading picture. The next couple of months inflation picks up, and then in the second half of the year you get the benefit of the fact that you had the HRA allowance the previous year. For me, the first clean reading is Jan to March 2019. That's rid of all these base effects in HRA and GST impact. So I think while the RBI will move its inflation forecast at some point, pay close attention to where the RBI thinks inflation is in the first quarter or the first half of the calendar year 2019. That's really what should drive monetary policy. Our sense is that's currently tracking 5% with some upside risk, and that should be enough to move rates. Let me just say one final thing. I think all of us agree that some monetary tightening is inevitable. I think it matters less whether it's June or August. I don't think we should panic. This is not 2013. India enters this episode with far better macro fundamentals compared to 2013, far more buffers in place. The rupee has been doing just fine in the middle of the pack. So the trade-off for the MPC is, do you want to be proactive, for which there is a good reason, and move in June and signal to markets that we are willing and ready? Or do you want to have more communication continuity, given that I cut my inflation forecast in April, I raise the inflation forecast, formally change my stance, prepare markets that the rate hike is coming in August? I think if it's a decision between June and August, I'm not sure these things matter, as long as the communication in June is appropriate if they don't raise rates.
But liquidity matters. So irrespective of what the policy would be, would you not want to hear something on liquidity? Already, balance sheets of the entire Indian banking sector has been crunched for want of capital and for want of provision, and because of provisioning pressures. What would you want to hear on liquidity? Would you want the MPC to advise that liquidity not be made tight in that sense? I mean, what should the MPC do?
See, I think that's a very good question. I think in terms of the liquidity, if you actually look at the total core liquidity adjusted for the government cash balances, that actually had turned negative 2 days back. Yes. Today it is positive. So irrespective of whether the RBI gives a signaling device to the market in terms of a rate hike or change unchanged, I think the markets have already factored in, and the markets are in a very liquid tight spot. And the bank will continue to raise lending rates irrespective of the RBI signal. So that means that the signal to noise ratio, basically the signaling which the RBI gives and the noise which the market emanates in terms of, for example, the volatility in the yield, that has actually been elevated. So I think it will be on the best thing for the RBI to address this signal into noise ratio. Otherwise, this financial instability component which has crept into the market should actually be curbed. And the other,
should they say we are moving away from neutral liquidity into tight liquidity?
No, they should not say that, because liquidity is already tight in the market, because and the banks are already raising rates. Deposit growth is on the lower side, and credit growth, if it picks up, deposit growth could the liquidity could actually be a problem. So I think instead of saying that, the central bank should stay on course on what is doing on the liquidity, but there should be a clear communication that this is my stance on liquidity, and what I want to do in the future date, I mean, that will be clearly
I have to go to the chairman for winding up comments, but I give you all each 10 seconds. Liquidity, Shamiran, what should the MPC stance be?
I think it's very tight, but it's not so much in MPC's domain, but in RBI's domain, and liquidity needs to be eased at this moment.
I would think the MPC would have the authority to advise if they wanted to. Anyway, what would you do?
I would not change the policy. The policy has worked well the last couple of years. Stick to neutral liquidity. Given our forecast, core liquidity goes into a deep deficit later in the year. From September onwards. They will compensate that through the provision of durable liquidity. I would not, at this point, move too many things at the same time.
Okay, but Dr. Sen, as the chairman, winding up comments, sir, and which way would you tilt?
Well, it's not a question of tilting yet, but I think one thing we should also keep in mind, that the signaling effect of what the MPC does should not just be focused on the market. There is another player who is equally, perhaps at this stage more important, which is the government. So if the government, remember we're coming into an election year, and if the government gets the feeling that RBI is actually holding back growth, you may see a reaction on the other side, which will undo whatever RBI is trying to do, and that becomes an unstable equilibrium. So one needs to be very, very, very conscious of the signal that's going to government. And I think the game that was played by Raghuram Rajan earlier, which is saying that if the government gives me credible evidence of fiscal consolidation, then I shall do X, Y, and Z, is not a bad way of going about it.
Okay, well, Dr. Sen, that puts everything on the table now. It's time for you, gentlemen and lady, to vote. Let me start first with the question, should the MPC hike rates or not? Hike or pause, Shomyo?
Not yet.
Okay, no hike. Shamiran? Yes, a hike of 25 basis points.
They should hike, but we're indifferent between June and August.
Okay, so you're not expecting in June. You have to vote.
Yeah.
Are you voting for a hike in June?
I probably would, but if it's August, it's, I would be indifferent.
You're not voting for a hike. Should I take you as a yes or a no?
For June, yes.
Yes. Okay, Sonal, is it a hike in June or a pause?
Question is should. I think they should hike in June.
Okay. Dr. Sen, well, there is 3 hikes now in June. Shamiran, Sajid and Sonal. Shomyo says no hike. Dr. Sen? Hold. But you outvoted, sir, this Monetary Policy Committee, 3:2 votes for a rate hike. Okay, now for a change in stance. Shomyo, is there a change in stance?
No.
No change in stance. Okay, you have to raise the board. It's a maybe from Samiran. Sajid? Yes, you have to tighten the stance. That's the point from Sajid. Sonal, what's your vote?
Tighten stance.
Yes, tighten stance. So 2 tighten stance, 2 not tighten. Dr. Sen? Oh yes, tighten stance. So 3 people asking for tighten. Clearly, the MPC is in favour of tightening and hiking. The final question to you, how many rate hikes do you expect in the current year? That is calendar 2018. 25 basis, 50 basis?
I'll look out for more data as of now.
Okay. So not vouching for anything. Shamiran? 50 basis rate hike this year. Sajid? 25 to 50 basis rate hike this year. Sonal?
50 basis
That's a 50 basis rate hike. Dr. Sen?
I think I'd wait till the August meeting.
Wait for more data. All right.
It's too early to take a call. Yeah.
Fair enough. But there is a definitive voice coming from this Monetary Policy Committee that a rate hike is called for. It is 3:2, so it's just 1 vote that is going in favour of a hike. In all probability, that's going to be the situation in the RBI's MPC as well. We know for a fact that Michael Patra and maybe Dr. Viralacharya are going to vote for withdrawal of accommodation and a rate hike. So we will wait to see whether it is 3 and a casting vote. Thank you very much, members of the Monetary Policy Committee, for joining me.